What is DeFi? Can you use it to earn passive income on your cryptocurrency holdings? Are there any risks involved? Will it change the future of finance? Well, stick around to find out. In today's video, we will answer these questions and more. Welcome to BlockLink Digital, where we simplify complex cryptocurrency topics for everyone to understand. Before we delve any further, please don't forget to subscribe to our channel and click the bell icon so you're immediately notified when we publish a new video. In today's video, we will talk about decentralized finance, or DeFi for short. If you're familiar with cryptocurrencies, especially Bitcoin, you'll agree that it is a remarkable form of money that isn't controlled by a single entity, say a central bank or government. Cryptocurrencies like Bitcoin and Ethereum can be transferred to anyone from anywhere around the globe in a matter of minutes. And guess, you don't need a bank or financial institution to achieve that. Simply put, cryptocurrencies like Bitcoin, Ethereum, and others are considered decentralized money because of some of the unique propositions we just mentioned. That said, transferring money is just the tip of the iceberg when it comes to decentralized finance, and you'll understand why soon. In a comprehensive financial system, so much is happening to make the entire process run smoothly. Besides sending money to one another, there are a whole lot of complex dynamics and services we leverage. For instance, loans, insurance, savings, stock markets, and other peculiar services are all built around money. Together, this variety of services makes up our financial system. But here is where things get a bit interesting. The financial system and all the services we mentioned earlier are completely centralized. Everything from the stock markets to the banks, to insurance companies and other financial institutions is controlled by someone in charge, whether it's a single individual or a group of persons. This centralized system, or what many call CeFi, poses some significant risks, including fraud, mismanagement, and corruption, just to mention a few. But what if it's possible to decentralize and disrupt the financial system, just as Bitcoin and other leading cryptocurrencies are doing? Well, that's exactly what DeFi is all about. What is DeFi? Now, the million-dollar question is, what is DeFi? To put things simply, DeFi, or decentralized finance, is a unique term given to financial services that aren't controlled by a central authority. Instead of relying on traditional intermediaries like banks, DeFi leverages blockchain technology to create a new financial system that's open, transparent, and accessible to everyone. Using decentralized money like cryptocurrencies, we can build a completely automated, robust financial system. By leveraging all of the unique perks of DeFi, we can build lending services, exchanges, insurance companies, and complex financial institutions that no one controls. Sounds confusing? Don't worry, we will break things down so you comprehend better. In order to build robust decentralized financial systems, we first need to have a powerful infrastructure that empowers us to run decentralized services. Luckily, we can trust blockchain technologies like Ethereum to help us do just that. In case you're just getting started, Ethereum is a DIY platform for writing decentralized programs. These programs are often referred to as decentralized apps, or dApps. Using Ethereum and its powerful architecture, we can write automated codes, also known as smart contracts, that help manage any financial services we intend to build in a decentralized manner. This simply means that we determine the rules for how the service operates. However, once we deploy these rules to the Ethereum network, we no longer control them, as they have become immutable. Interesting, right? Once we have a system in place, such as Ethereum, which is great for building decentralized apps, we can go ahead to build our decentralized financial system. Now, let's look at what makes DeFi particularly interesting. We will focus on some of the building blocks that comprise DeFi. Components of DeFi. Just so you know, the first thing every financial system needs to operate smoothly is money. You may be wondering, why don't we use Bitcoin, which has established its supremacy, or Ether, the native currency of the Ethereum blockchain, to build decentralized financial systems? Well, here is what you should know. While Bitcoin is indeed decentralized and has many exceptional perks, it has a very basic programmable function. Plus, it isn't compatible with the Ethereum platform. On the flip side, even though Ether is compatible and programmable, it is insanely volatile. Since our objective is to build solid and reliable decentralized financial services that people will be interested in using, we will need a more stable currency to operate within this system, which is where the stablecoins come in. What's interesting about stablecoins is that they are pegged to the value of real-world assets, typically major fiat currencies like the US dollar. However, for a robust DeFi system, it's important to leverage a stablecoin that doesn't use fiat money reserves for maintaining a peg. Going that route will mean relying on a central authority, which is what DeFi wants to disrupt. Here is where DAI comes in. What is DAI stablecoin? For starters, DAI is a decentralized digital asset or cryptocurrency that is pegged against the value of the US dollar. It simply means that one DAI is equivalent to $1 US. Unlike other stablecoins you might know that are directly backed by the US dollar reserves, DAI functions differently. You see, DAI is backed by crypto collateral, which is absolutely mind-blowing. The interesting part is that it can be viewed publicly on the Ethereum blockchain. Another unique thing about the DAI stablecoin is that it is over-collateralized. This simply means that if you were to lock, say, $1 worth of Ether, you'd be able to borrow 66 cents worth of DAI. And any time you decide you want your Ether, you can simply pay back the DAI you borrowed, and your Ether will be released. But what if you don't have Ether to lock up? Well, it's simple. You can simply buy DAI on an exchange. And because DAI is over-collateralized, it means that even if the price of Ether becomes volatile, the value of your locked Ether backing the DAI in circulation will remain at either 100% or more. This makes DAI stablecoin a genuinely trustless and decentralized stablecoin, which isn't controlled by a central authority. Given this unique proposition, it's no surprise that DAI is the perfect form of money for DeFi services, not financial advice. Now that our imaginary decentralized financial system has a stable decentralized money, it's time to look at other additional services that make up the DeFi ecosystem. This is where decentralized exchanges, or DEX for short, come into play. What's special about decentralized exchanges is that they operate according to a set of rules, coded into the smart contracts. These rules allow users to buy, sell, or trade their digital assets. Just like the DAI stablecoin, most decentralized exchanges reside on the Ethereum platform, meaning they operate without a central authority. Here's the catch. When you trade on decentralized exchanges, there are no exchange operators, sign-ups, identity verification or withdrawal fees required. More interestingly, your funds are secured. Unlike centralized exchanges, where you're required to make deposits, with DEXs you don't need to deposit funds in an exchange account before you can conduct trade. This entirely eliminates the risks of exchange hacking, a common phenomenon in centralized exchanges. Understanding decentralized money markets. That said, the range of DeFi services doesn't end there. This brings us to decentralized money markets that connect borrowers to lenders. Imagine a scenario where you need to pay rent or buy groceries, but the only funds available are your cryptocurrencies. But instead of selling your cryptocurrencies for fiat, you can simply deposit your crypto on a decentralized exchange and borrow against it. This is exactly what decentralized money markets do. Thankfully, there are dozens of platforms out there, including the likes of Compound, that connect lenders to borrowers. What's special about these platforms is that they enforce the terms of the loans and distribute interest to lenders. DeFi is incredibly popular because it offers crypto owners the opportunity to earn interest on their cryptocurrencies. This has given rise to yield farming. For those who are just hearing about this for the first time, yield farming refers to the practice of putting your digital assets to work while exploring the opportunity to earn the most return possible. Now that we understand decentralized stablecoins, decentralized exchanges, and decentralized money markets, we are sure you also want to learn about decentralized insurance too. So let's dive right in. Without mincing words, all of the new financial products for decentralized finance we covered have some risks to them, and we will cover some of those shortly. With the apparent risks of these new financial products, wouldn't it make sense to create a counter service that insures your funds, just in case something goes wrong? Well, that's where a decentralized platform that manages insurance comes in. Imagine having a decentralized platform that connects individuals who are willing to pay for insurance with people who are willing to offer this service for a premium. Wouldn't that be great? Well, with decentralized insurance platforms, we can achieve all this and more. And the best part is, all of this happens autonomously, without the prying eyes of a central authority. The inherent risks of decentralized finance. While DeFi offers many brilliant benefits, it isn't without risks. For one, DeFi is still in its infancy, which means things can go wrong. More so, we have seen instances where smart contracts aren't correctly coded. providing loopholes for malicious actors to steal money. If you ever decide to test out any of the existing DeFi services, do due diligence and only invest money you're comfortable losing if things go south. Now, let's get to the juicy part. Can you use DeFi to earn interest on your cryptocurrency holdings? Absolutely. DeFi platforms offer various ways to put your crypto to work and earn passive income. You can lend your crypto to others and earn interest on those loans, participate in liquidity pools to earn fees, or even provide collateral for decentralized borrowing and lending. It's a fantastic opportunity to make your crypto work for you. Talking about the future of DeFi, let's reiterate that DeFi has the potential to revolutionize finance. DeFi has the power to eliminate middlemen, increase financial inclusion, and provide more control and ownership to individuals over their money. It enables access to financial services for the unbanked and underbanked populations worldwide. The decentralized nature of DeFi also fosters innovation, as developers can build on existing protocols and create new financial products that were previously unimaginable. There you have it, guys. We hope today's video has helped you better understand DeFi and its many intricacies. While the future impacts of DeFi are not yet profound, there is no denying the fact that decentralized finance has the potential to disrupt the traditional finance landscape in ways we have never thought possible. Until next time, stay true to the innovation.